We think that basically Inphase, and if you don't know them, they are an inverter manufacturer, basically a U.S. play on the rise of solar power here in the U.S. and globally. And we think they have potential to beat on EPS pretty significantly this year and next versus where consensus is at.
Demand pull from power gen. That's really significant. Here's the problem, though. July versus June, just on production itself, you're running 2 BCF higher. And that's taking into account that June was actually higher year over year as well. So the production side of the house is not fulfilling the prophecy that I would have preferred. But what's also very significant, and when you consider that the cash cost for natural gas is significantly below the cash cost for coal, people can point to government fiat pushing coal into the grave. But I will tell you that the demand supply fundamentals of nat gas were pushing coal into the grave long before.
So the lower Henry Hub is good for U.S. producers. Excuse me. A larger netback because TTF in Europe on a dollar per million BTU basis, it's slightly under 12. Asia's around 12. So that's a nice solid, netback for the spot market. There's more supply coming online, US, Canada, other places, more supply coming on next year. So global prices should come down. That netback should shrink a little bit, spur some more demand.
I don't see what stops crude oil from getting below 40 to do what it always has done, most notably since the peak in 2008 and since that peak that put in a high in 1990 of getting back to 40 and shutting off these excesses of supply versus demand on a global basis. Very similar to natural gas.
Good morning, good afternoon, everyone. This is Rob Barnett, and I would like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. On the call today, we've got 3 of our regulars, all from North America. So we'll start with Mike McGlone, fellow Floridian in our Miami office today, calling in, and then swinging up to the Northeast, we've got Vince Piazza joining and Talon Custer. So that's the crew for today. If you have questions for any one of us, just pop it into the chat and we'll try to work it into the discussion. So just looking at the screen here at the moment, it looks like Brent crude is about $73 a barrel, and natty gas here in the U.S. Closer to $3 per MMBTU. We're going to get perspective from all of you on this. So, Mike, let's come to you first, senior commodity strategist. You've had a bearish take on the markets for some time now. What do you make of the screen and where we are today?
It's still bearish, and I have to put it in the bigger context of commodities. To me, energy is very much not isolated. I put them in the same bucket as grains because they're trading in very similar cycles and very similar elasticity downward cycles from that peak to 2022. And I have to mention grains because every day that goes by, more and more of the grains are becoming energy, just that rapidly advancing technology. So I appreciate the timing of you having me on. I just published my August Energy Outlook, included some my colleagues' stuff in there, certainly what you write, Vince. And I pointed out, so if looks at WTI, the high for the year is 80, the low is 55. We're stuck here at 69. Pump recently on Trump comments. We know there's a vested interest in Trump making prices go lower, and I still stick with that bias. I don't see what stops crude oil from getting below 40 to do what it always has done, most notably since the peak in 2008 and since that peak that put in a high in 1990 of getting back to 40 and shutting off these excesses of supply versus demand on a global basis. Very similar to natural gas. Natural gas last heating season had a colder than normal winter. I missed it being down south in Florida because I love pond hockey, and it was a great pond hockey season this year up in Connecticut and in Chicago, which I grew up doing. But so are we going to get that second colder than normal winter? Now, we've been priced for that. That January natural gas contract has been above 5 for a while. Now I see Jan down at 4.43. I think that's more still priced for a colder than normal winter. despite the fact that we have a trend towards global warming. So to me, that's the risk, is we're going to do what almost always happens in natural gas. It got to near 5. The high this year was 480. And it goes back to 2. What stops that trajectory? That's where Vince can really kick in. And I do appreciate his outlooks pointing out that inventories are actually a little bit lower than normal this year. And then I had to also, I reiterated something that I focused on years ago, this paradigm shift that's happening in the US. That's the macro thing, is we've reached a new high in miles, total miles driven, around 3 trillion or so. I use the 12-month average, around 277 billion. It's the highest ever. Yet the total demand for overall liquid fuels and crude oil, particularly motor vehicle gasoline in this country, is declining. See that paradigm shift? That's never happened historically. And the US is way far behind most of the rest of the world adopting these cheap EVs from China. So to me, that's a big picture macro. Normal fact you learn in commodities is they typically go down because they went up. We're still in that stage going down because they went up too much, with the notable exception of gold and a little bit of copper, which is distorted. So in the grain and so in energy, I still see those risks heading lower. And it's going to take some kind of surprise to spike them and keep them up versus that normal propensity to find a low price cure. So I'll end with this. It's harvest. Touching on harvest in the US now, that somewhat matters because oftentimes you put lows in August, and we did last year in corn. Corn, in the US, 1/3 of our, almost third is used for ethanol, of corn is used for ethanol. So there's that pressure factor. And we're sitting in these quiet markets. And one thing that's really changed earlier in this year, I also watched managed money net positions. They spiked really bullish long in the beginning of the year, and they're still somewhat heading lower. And that's mostly in the in petroleum and the grains. Back to you.
Okay, thanks a lot, Mike. Vince, I want to come to you, get your perspective on the market, particularly on the gas side of the equation. For anyone who doesn't know, Vince has a couple of focus ideas on natty gas, on both the commodity and some of the exposed E&Ps here in North America. So Vince, read the tea leaves for us.
Yeah, so if I were just to focus on the demand side of the equation, July demand is significantly higher than June. So just power demand aside, is roughly running on average 7.9 BCF a day higher month on month. We've had a couple of days here where it's been scorching hot. I'll give you an example. If I take a look at from July 25th through July 30th, we're running at well into the 50 plus BCF a day demand pull from power gen. That's really significant. Here's the problem though. July versus June, just on production itself, you're running 2 BCF higher. And that's taking into account that June was actually higher year over year as well. So the production side of the house is not fulfilling the prophecy that I would have preferred. But what's also very significant, and we talk about power gen as the cyclical factor, the structural factor, the structural growth factor, LNG net flows. So think of feed gas into facilities. That's running roughly 3.6 BCF a day higher year over year, and month over month, it's running 1.3 higher. So from the structural perspective and from the cyclical weather perspective, the demand side of the equation is definitely there. It's just that we have tons of volume coming on through, more so than I would have imagined. And even on the most recent earnings call, well, we'll get the earnings call today from Expand, but on the release last night, Expand, which is now the largest E&P natural gas producer, even Expand is not really growing output. So a lot of this output is coming from the private market side, and it's coming from the associated gas side. The demand side is there. It's just we have had just an enormous amount of output catch up here in July versus June, and even July versus July of last year. So that's somewhat disappointing. Overall, though, it's $3 here. It's been $3 for a while here. You're down 16% year over year. Operators really aren't growing output. At least the public guys are not. It's coming out of the private market. And if that continues, we'll have to revisit. But really, for the most part, I still think gas is a winner here relative to where I see crude oil. Crude oil is relatively flat. We've had a little bounce here because of what many would perceive as potential for additional sanctions on Russia energy. Again, these are transitory issues. But in general, if I take a look at just longer run market share capture, we're still in favor of nat gas versus crude. I'll leave it there. I'm sure there'll be a ton of questions, but I'll let the others comment as well.
Vince, real quick before we move over to Talon, I want to ask you, just since it's in the news cycle. So just yesterday, the Trump administration was taking steps to reverse this so-called endangerment finding, basically rolling back greenhouse gas climate regulations. And you mentioned the demand pull from the power sector. Just curious, I think I know the answer, but I'm curious, do you think any of this policy maneuvering in DC affects the thesis on how gas plays in the power sector?
No, not really, because coal was dying its own death, and that was really a function of the longer term trajectory of natural gas as a feedstock into the power gen cycle. And when you consider that the cash cost for natural gas is significantly below the cash cost for coal, people can point to government fiat pushing coal into the grave. But I will tell you that the demand supply fundamentals of nat gas were pushing coal into the grave long before. So I appreciate that this tends to create sentiment on the extremes, more the political extremes, but from an investment perspective, and I'll say this, in the 13 years I've been here, I have had limited conversations about policy and more conversations about the longer term effects of demand supply fundamentals. So to me, policy can be implemented and policy can be removed. And this political volatility tends to work itself out because people become desensitized to it. So what really wins out is the longer run demand supply fundamentals of the commodity, which, by the way, is a finite resource, right? So we'll leave it at that.
Fantastic. Okay, Talon, I want to get your perspective on where things stand. Anyone who doesn't know Talon's franchise, he covers LNG and some of the midstream components of the gas complex for us. So, Talon, what do you make of where Henry Hub's at relative to the global gas benchmarks? Just looking at the screen, TTF over in Europe's about 34, 35. Euros a megawatt hour. That's I think $15-ish per MMBTU. But give a sense, how's LNG looking? And I will note, thanks for everyone who's been asking questions. And there's a specific question that maybe you'd be well positioned to answer, Talon, just on kind of the role of Canada and the global LNG market. If you could touch on that at the end of your remarks.
Yeah, so the lower Henry Hub is good for U.S. producers. Excuse me. A larger netback, because TTF in Europe on a dollar per million BTU basis, it's slightly under 12. Asia's around 12. So that's a nice solid netback for the spot market. There's more supply coming online, U.S., Canada, other places, more supply coming on next year. So global prices should come down. That netback should shrink a little bit, spur some more demand in Asia. But LNG Canada, they finally came online, shipped a few cargoes, and that should continue to grow. 2 trains, 14 million tons, should really help that Canadian market up there where prices are really low.
Fantastic. Talon, give us a sense of how this is feeding into the 2Q earnings cycle. I know most names haven't reported yet, but what's your expectation for what the read across on commodities is going to look like into some of the equity names?
I mean, midstream is less sensitive to the commodity prices. Some of them will be affected by, lower NGL prices, lower oil prices, but for the most part, they're just less sensitive. So it's not going to be like the E&Ps or refiners. On the LNG front, it's more optimistic, with all the growth. There's fewer names that we cover, but, Cheniere looks like they most likely had a pretty good quarter. I don't cover Venture Global yet, but obviously I follow them. Plaquemines is ramping up much faster than expected. They're shipping a ton of cargoes. So on the LNG front, it looks pretty good. And, there's just more optimism surrounding deregulation. So that bodes well for pipeline guys that are trying to expand, not just in Texas and Louisiana anymore, but expansion projects elsewhere. So it's looking better on that front. But yeah, those with marketing businesses exposed to NGL oil maybe hurt a little bit, but for the most part, midstream looks relatively status quo.
Give us a sense on just the couple of the big themes right now. So obviously LNG is a bit perennial, but we've heard a lot over the last 18 months on data center power demand and even possibility of some, direct connection behind the meter on gas. Are any of your companies still talking about that thematically?
Oh, absolutely. That's a highlight every quarter. Any energy transfer, I don't know if that they have a deal for data center power. I don't know if it reached FID yet. Williams is currently working on a project in Ohio. It's called Socrates. Kinder Morgan has several projects to deliver power. Not all of it is for data centers, but it's mostly focused on the Southeast. So that's a region we're seeing a lot of potential in. The Northeast as well, obviously Northern Virginia. So it continues to be a hot topic, and it's the forecast range last year was like 2 to 10 BCF. I think the floor has picked up a little bit. I think it's more. I lean more like my colleague Vince there toward the low end, and I still I'm leaning that direction, but more in the middle now, more closer to the middle. Because clearly there's demand for the projects are coming online, and like you said, behind the meter is increasingly popular. They're getting, maybe those less fuel efficient gas plants, looking to build laterals off of main pipelines. So for sure, LNG is the main one. Exports to Mexico, but power and AI demand is certainly up there.
Right, fantastic. Continuing just kind of on the 2Q earnings cycle theme, I'll just weigh in real quickly. We put out an update for our focus idea on Inphase this morning. I'll drop the link in the chat for anyone who hasn't seen it. I'd encourage you to take a look. We think that basically Inphase, and if you don't know them, they are an inverter manufacturer, basically a U.S. play on the rise of solar power here in the U.S. and globally. And we think they have potential to beat on EPS pretty significantly this year and next versus where consensus is at. And we lay out our thesis why. 2Q was a pretty good set of numbers for them. They beat consensus on EPS, and we really think that feeds into the story. We think they'll be able to preserve margins here in the near term, despite all the tax policy changes. So anyway, take a look at that. And Vince, just kind of continuing on the 2Q earnings cycle theme, want to come over to you as well. How do things look in your perspective for the gas patch here in North America?
So we're going to get another stream of gas guys reporting on the next week or so. Obviously, Exxon and Chevron coming up on Friday. Of course, for Chevron, the biggest hurdle is now past them. The Hess transaction that closed, that's the easy part, right? Now the hard part begins. The hard part being integrating a rather large and diffuse organization into the Chevron umbrella. But at least that piece of the overhang is off the name. From a production perspective overall, whether it's nat gas or crude oil, we really don't see a lot of growth. I would have said that last year as well. I was just mentioning to someone offline that the associated gas in the Permian is up roughly 3 BCF a day since the start of January. So that's where a lot of the gas growth is coming from. So with oil still in that high 60s range, that's almost a Goldilocks for these guys. And that means that whatever gas comes out of those wells, the associated gas comes out of those wells, that's just upside from a price realization perspective, even though Waha pricing is fairly low. It's above zero, and that is significant. Matterhorn definitely provide a little bit of relief for gas producers. So that seems to be progressing well. Although we don't really see where that next leg of growth is coming from. I think that pipe and Talon can offer more on that. But that pipe seems to be pretty satiated in terms of the draw through that facility. So I don't really see anything earth-shattering this quarter. I see a reiteration of production targets, which would be more muted. Capital discipline seems to be the mantra with return of excess capital. So dividends, modest growth there. The upside coming from the supplemental payouts, which is really geared toward a formula based on free cash flow. But I really don't see anything coming out that would move the needle for me. I think really the next big step, the next big tell is going to be 4Q into 2026, which gives us a better idea as the cadence. That'll also be the first month of, really the first 2 months of draw season, November and December being the kickoff to the winter draw cycle. And we should have some more clarity on nat gas. But for crude, I think OPEC is back in charge. And we'll see here the next challenge here is going to be what happens with any particular additional penalties placed on Russia. So, but that remains to be seen. I'm not sure if we talked about, Rob, the EU trade deal and what it means for energy, but maybe toward the back end there, as we close up, we could offer up a couple of comments on that as well as it pertains to energy from my gas exports.
Yeah, fantastic. First, I want to get Mike's reaction to kind of the story from the producers. Mike, given the sort of standing bearish view and kind of what you're hearing from Vince there, what are the catalysts that you're looking for that potentially take us lower? Is it the behavior of OPEC? Is it something more macro? And I'm just looking at the S&P 500. Seems to have been on a pretty good tear since April. How does the sort of global market perspective feed into kind of what you think could happen on commodities?
Well, I'm glad you mentioned S&P 500 because it just can't ignore it. It's something I've been speaking about for a while, having run value at risk models in crude oil. If the S&P, it's up 10% on the year, great. It's wonderful. That's been the expectation for most analysts. That's wonderful. But now most analysts are adding another 10% for the year. It's just usually how it happens. It's not going to go down until it goes down. It's just we're at that extreme now, highest ever versus the rest of the world, versus GDP, versus commodities, a 25-year high. It's got to keep going up. And that to me is a risk in 2H. Now we're at the low volatility time of year. We know we're going to get some volatility into the next couple months, and we're going to get a backup. Questions how sustainability is. The key point is if S&P 500 ends up down in the year, there's virtually no chance that crude oil is going to be up unless there's some kind of shock, which I can't predict. It's just a normal cycle. So to me, that's the macro big picture. It has to stay up, or from I see from commodities, it's going to tilt into that normal deflationary cycle that history shows we always get from inflation. Best example on the planet is 1.73 10-year note yield in China. I mean, I remember this 30 years ago when I traded JGBs in Japan. Severe deflationary forces in the world's largest demand pull commodity market. Yes, we see their deficit spending is running 300% to GDP. They have to do that just to keep going. And then they're facing unprecedented tariffs, not just from us, but from the rest of the world as they try to export their deflation and replace fossil fuels with technology. Why? Because they don't have the fossil fuels we have. So to me, this is a pretty macro big picture. May we live in interesting times type cycle. And that's where you can't, when you make a call like I do, you can't expect it to happen overnight. Yeah, that's the key thing. So I look at what's going to change this format. First of all, bottom line, by the end of the year, if the stock market is down from these levels, expect crude oil to head towards 40 at a normal cycle. Expect copper to come off $10,000 a ton, which is it's significant resistance. Right now, copper, if it closes here, is around the highest end of the year close ever, which is London copper, 9,700 bucks, head towards 8,000. That's normal. You need the stock market to go up for these things to stay that way. And that's the problem, with the notable exception of gold. And to me, that's what gold's figuring out. The key thing to point out in what's happening in commodities is you see we're settling into these bear markets. We see that in crude, natural gas is maybe a derivative. Grains are certainly just stuck there. But everything except gold. And why is significant inflows into gold ETFs. We had 4 years of outflows. Now they're switched to inflows. That's a significant shift. So investors are saying, well, yeah, maybe I should take some of my appreciating risk assets and put it into store value. And central banks are still buying. So as a commodity guy, I still see gold as the best performer into 2H. Unfortunately, it's already done a lot of that already. Into the end of the year. And I just hope something can shift that format where I can say by the end of the year, yeah, the US stock market, it added another 5%. It's wonderful. It's going to keep going up. And we're not going to get that normal deflation from inflation. And that would be great. But just studying I'll end with this. You go back 100 years, end of the year basis, take the Warren Buffett model as the US stock market market cap divided by GDP. It's the highest since 1929. And like I said, only current comparable examples are 1989 in Japan, 1929 in the US, and it's got to be different this time. Otherwise, the normal cycle for almost all commodities, you got to get cheap after getting expensive, and crude oil and grains are clearly on that path.
All right. Thank you, Mike. Appreciate your very colorful perspective there. So for everyone listening, we are going to run over a few minutes, but I'll just quickly do a quick advert. If you are not in our 2 client chats, I'd encourage you to reach out and we'll help you get added to that. So we have the BI Energy Exchange, the BI Future of Energy, both active chats. We're in the chats, but many of you are as well. So if you're just unaware of that and you want to be added, reach out. We'll help you get involved in that because it's sort of a very active discussion on all of these topics. It's not just Wednesdays at 10 a.m. It's 24 hours around the clock, and many of you share your thoughts on the market as well in those chats. And so if you would like to participate, please reach out, and we'd love to have any additional folks who want to be participants in that join us. And with that, I'm going to bring it back around to Vince's comments on the U.S. EU trade deal. And Talon, I want to come to you first on that because I think probably there's a lot to unpack on the LNG front there. So, what's your read on the latest trade developments? I feel like trade is so hard to follow because it changes every day. But given what we've heard recently, what do you make on U.S. LNG and flows into Europe as a result of the latest announcement?
Yeah, it doesn't make sense to me. I think it's all about optics, rhetoric. It looks good, but the numbers don't make sense. I think I saw, it's 750 billion over 3 years to 2028. Europe imported something like 80, so they would have to more than triple it. The US exports something like 330 million of energy, so it would almost have to be virtually like unilateral, which isn't going to happen. So I think it's more just talk. I mean, Europe does need more US LNG if they're going to get off Russia, because obviously they still import some. They import some, from Russia. But again, it's all bark, no bite. It reminds me of Trump's first term, the $250 billion China deal that amounted to nothing. It reminds me of, after Russia invaded Ukraine and the Biden administration and the EU came to some sort of agreement, and basically all it was stating that the US is going to ship more LNG to Europe, and they did, but it was going there anyway because most of US, even though it's backed by a long-term contract, most of it's considered spot, it's flexible. So that the highest bidder was in Europe, that's where it was going. So to me, unless they come out with something more concrete and firm deals, it's hard to dictate, what private companies are going to do. But on the face of it, the numbers don't make sense.
Vince, what do you make of the latest agreement and how it feeds into your space?
Yeah, I would agree with Talon. So if we aggregate all of the exports, energy exports from the US to the globe, and this is EIA data, so I may miss a billion here or there, but I think last count, the yearly total was somewhere around 320 billion of US energy exports. So I think if you were to divvy up, I think the agreement was 750 over 3 years. That's roughly 250 per year. That means the vast majority of all exports would head to the EU, and that's just probably not realistic. And so I'm going to refrain from making another outlandish comment, but let's call it what it is. I think it's just window dressing for the most part. They're going to need more LNG because from the way I see the storage progressing over the months of July and August, they're going to need to refill a little bit more. And if it's a typical August for the European corridor, heat is fairly typical for that time of year, especially around the August time frame. So we're going to need more versus less. So the molecules were headed there anyway, and as Talon says, it's almost window dressing at this point. But it's unrealistic that 250 a year is dedicated exclusively to the European corridor, unless I'm missing something. But
all right, very interesting commentary. I think we'll leave it there. So I just want to thank everyone for joining us today. If you have follow-up questions, we are all green dots on the terminal right now. So just shoot us an IB, ask any follow-ups if there's anything on your mind that we didn't get to. And just a reminder, we hold these calls every Wednesday at 10 a.m. New York, 3 p.m. London, and we rotate around the various team members here at BI. Sometimes we have external speakers. So if you've got recommendations for topics or somebody you'd like us to have on to hear from, just reach out and let us know, because we're happy to try and arrange that. Take care, everyone. Have a great rest of your week and look forward to seeing you next week. Cheers.
thank you.